Hi everyone, in this video we are going to start analyzing bonds, long-term liabilities and specifically bonds, how we record interest expense, what it means that it's an interest payment, how we record the book value of a specific bond. In this particular example, what we have is a 10-year bond with a face value of $1,000. It's sold at the end of the year of 2021. It has a coupon rate of 6%. The price of the bond is $1,162.22, and yield to maturity is 4%. So let's clarify the terminology first. The 4% is the interest rate that the market demands from this particular bond. There is another percentage which is 6% coupon rate, and what that means is how much the company is going to pay on a regular basis to the bondholders. In the past, the bonds had the coupons. You were bringing literally the coupons at the due date, and you were getting your cash. So that's what that coupon rate is. Now, the first thing is, how are we going to record the sale of this particular transaction? We know that the bond is sold for $1,162.22. What we are going to do is we are going to increase our cash, and we are going to increase our bonds payable. By the same amount. This is what we are going to record as sale of the bond. Now I'm going to do the entire amortization, and we are going to look at the other scenarios separately. Let's start with the cash outflow. It's for 10 years. It's an annual coupon. In the United States, the coupons are semi-annual, and we are going to analyze it in a video that I'm going to post later. But for simplicity, we are assuming this is a annual coupon, and it's also called European. European bonds typically pay on an annual basis. American bonds pay every 6 months. And as I mentioned, we are going to look at American style later. So we are going to start with the cash outflow, also known as interest payment. This is where the very first percentage, the coupon rate percentage, comes into play. We are going to take the $1,000 face value, multiply that by the coupon rate, and this is what the company is going to pay across all these years for 10 years. And at the end, this year, they are not only going to pay the $60, they are also going to pay the $1,000 face value, and then they will close their books. Now, beginning book value is what we have here. We were told that the book value when the bond was sold was $1,162.22. Now we are going to calculate the interest expense. The interest expense for the very first year is the beginning book value multiplied by what the market is demanding at the time of the sale of the bond. It doesn't matter if the interest rates change or not from accounting perspective. If the interest rates change, the market value of the bond will change, but the accounting treatment is not going to change. So we are going to calculate the interest expense by looking at the beginning book value of the bond, and then we are going to multiply it by what's called yield to maturity, also known as what the market demands for that bond. The ending book value is going to be the beginning book value minus what you are paying to the bondholders. That's going to decrease the book value, plus the interest expense. So as a result, your ending book value is going to be $1,148.71. I'm going to pause the video right here. We are going to do the rest of the years in the next video.